Options trading can be a great way to increase profits and hedge your positions, but it's not without risk. It doesn't matter how good of a trader you are, there will be times when you're faced with losses or a less than ideal profit. One of the key pillars of becoming a successful trader is knowing how to manage your open positions. There are some hard and fast rules when it comes to risk management, like max portfolio drawdown or when you typically take profits, but there's also going to be some variation on how you manage your position depending on what type of options you are trading. Today we're continuing our journey through one of my favorite trading books titled Options as a Strategic Investment. As with any trade, you need to follow up on your position and take appropriate action as the market fluctuates. McMillian's insights in the latter part of Chapter 3 are a fantastic guide for learning how to protect your capital when you buy call options. With that said, let's get into it. Picture this for a moment. You're sitting at your desk, monitoring the stock market like a hawk, and you've just bought a few call options. Maybe you're confident and excited while envisioning all the money you're going to make as you step away for lunch. But unfortunately, after you come back, the underlying stock you were betting on takes a nosedive. Maybe panic starts to set in. Understandably so, your hard-earned money is at stake. What do you do next? Well, the simplest course of action, and one that is probably the wisest, is to sell those calls and cut your losses. It might seem like a bitter pill to swallow, but it's better than clinging to those calls, praying for a miraculous rally before they expire. It's almost always best to be decisive. Every time I've told myself, this time is different, and held on to a position longer than I should have, it's come back to bite me.
It's alive! Ow!
If the stock is performing poorly, don't hesitate. Sell those calls and preserve what's left of your capital. One way to ensure that you never miss your stop is to set stop losses on your options so that if you do step away, you don't have to worry about logging back into your account with your calls 50% down. But here's the catch. The fills on those stop orders aren't always ideal. It can be frustrating to watch your carefully planned exit strategy crumble due to less than optimal execution. This is where the concept of a mental stop loss comes into play. McMillian recommends choosing a stop loss based on an exit point for the underlying stock itself. If that stock breaks below a support level that you've identified, it's your signal to act. Most brokerages allow you to set alerts for when stocks hit certain levels. You can also set a trailing stop loss. Having mental stop losses before you even open the trade helps eliminate wishful thinking and emotional attachment to your calls. Stop losses help safeguard your remaining capital to trade another day. Let's say that next day is bright morning and you're once again glued to your trading screens, watching the stock you bought calls in start to climb. The adrenaline rush starts to kick in as the numbers tick upwards, but as an experienced trader, you understand the importance of staying grounded. As the stock rises, you remind yourself not to get greedy, yet you still ask yourself, should I take profits now or hold on for higher gains? McMillian stresses that real traders don't think in terms of percentages like, I've only made 20% or 30%. Instead, we focus on seizing opportunities when they present themselves. What do I mean by that? Well, when the stock hits the price target you had in mind, don't hesitate, take some profits. It's actually a good idea to have multiple price targets in place when you open a trade so that you're not tempted to risk everything for an undefined amount of higher profits. It's a simple yet crucial rule of thumb that can help keep you on the right track. After all, what is the point of spending all this extra time and energy to learn about the markets, learn to trade if you don't lock in profits?
David, you have taken in $15 and given away 50 cents worth of crap, which gives us a net profit of $14.50. It's a profit deal.
Taking partial profits offers a way to enhance your position without exposing yourself to unnecessary risk, like losing everything that you've gained and then some. Right now you might be thinking, cool, stop losses and take partial profits. Heard that one before. Well, those are only the hammer and nails of a whole toolbox of strategies. In the next video, we're going to continue reviewing Chapter 3, which is all about advanced call buying follow-up action. If you enjoy this type of content, feel free to hit the like and subscribe button. Thank you for watching, and remember to trade gingerly.